Welcome to General Accounting. This is the first of 12 chapter videos that will be shared with you over the next several weeks. The first 11 are directly related to chapters that will be discussed during the course, and the 12th is an optional video that will share with you insights regarding the statement of cash flow, a financial statement that is not discussed in your textbook. Let's begin with a general definition of accounting. Accounting is really about telling a story. However, formally, it involves a process that begins with analyzing financial transactions, classifying those transactions into five categories: assets, liability, equity, revenue, and expenses. We will discuss the definition of each of these as we go along. Recording those transactions in the books of the business or entity, summarizing those into financial statements, the income statement, the balance sheet, and the statement of cash flow, and then reporting that information to interested users. So accounting really starts with transactions, and to the extent that we know how to record transactions, we will then know how to prepare the reports that follow from those transactions. The specific approach that I will share with you is based in part on a book which is being published titled Accounting is Not for Dummies: A Smart Guide to Understanding Financial Accounting, that I have written, and it is currently being edited for publication. However, getting back to the topic of financial transactions, these financial transactions can be grouped into three major sections. There are financing transactions. These transactions would include obtaining funding to start a business. This could be coming from the owner of that business or from other investors. It could be funding coming from a bank. So any type of transaction involving the funding of the business, whether it be from the owner or from an outside source such as a bank, would be an example of a financing transaction. So the funding or the repayment would be financing transactions. Another category is investing transactions. And these transactions are related to the purchase and sale of long term assets, such as a building or land or equipment. So the purchase or sale of those types of resources would be grouped under investing transactions. The third is operating transactions, and these are the day to day activities of the business: buying supplies, selling inventory, selling your services, selling a product, paying your workers, collecting monies owed to you by your customers. All of those come under the category of operating activities. And you will therefore be seeing these three categories as you go through each of the chapters in the book, beginning with chapter 1. As I said, the key point is to understand transactions. So how do we know that we have a transaction? Well, first of all, to have a transaction, a financial transaction, you need to have at least two parties. So you cannot have a transaction with yourself. There has to be at least two parties. For example, a buyer and a seller. You go to the grocery store or the supermarket, you buy an item, you will be the buyer and there will be a seller. Or there could be a renter and a landlord. So it could be that you are the landlord that is allowing someone to use your facility, or you could be the renter using the facility that is owned by another entity. Another example would be a lender and a borrower. So the bank most likely would be the lender, and the borrower would be the customer. And then we have a special relationship, which is the business owner and the business itself. In accounting and in the eyes of the law, these are two separate entities. So even if you are a sole proprietor, the business is viewed as separate from the owner. And this distinction is important for us in accounting because that's going to enable us to record transactions involving the owner and that particular business. It's referred to in accounting formally as the economic entity concept. However, just realize that the owner and the business are regarded as separate entities. The second key point to note as you try to understand transactions is that each party, so there has to be at least two, and each party will be getting something and giving something. So for every transaction, each party will have a get and a give. For example, if you are the buyer, then you get the product or service that you bought, and you would give cash or a promise to pay for the item in the near future. If you are the seller, you also will have a give and a get. You will get cash for the product that you sold or the service that you sold, and of course, the give would be the product or service. So every single transaction, if it is a financial transaction, will have a get and a give. And so you will need to identify both the get and the give. It doesn't matter which you identify first, but you have to identify both the get and the give. If they are not present, or if only one is present, you do not have a financial transaction. The other key points that you should note regarding transaction analysis is that you have to determine the get and the give for the specified party. So we need to know which party we are focusing on and determine the get and the give for that specific party. Then we need to record both the get and the give, not just the get or not just the give. We have to record both the get and the give for that specified party. And finally, the get and the give must be the same amount. To illustrate the transaction analysis process, we're going to utilize problem 1-3b from your textbook. You will be assigned problem 1-3a. We are going to be focusing on problem 1-3b. So if you understand what I do with problem 1-3b, you will be able to successfully complete problem 1-3a. Notice that this problem has to do with P. Short's attorney at law, and this attorney decided to open his business on October 1, let's say, of the current year. And the firm decided that they were going to be classifying their transactions using these specific group names. We will talk some more about that later on, but for now, we are told that these are the group names that we should use to record the transactions. Rest assured, once you figure out the get and the give for each transaction, you will know which of these categories you should put your entries in. So it starts with identifying the get and the give. Again, based on the system that I use, we're going to identify each get with a blue and each give with a green. Let us start then with the first transaction, and note that the focus here is on the business, P. Short's attorney at law, as opposed to P. Short's himself. So we're asking the question, what did the business, not P. Short's, but what did the business get? What did the business give? The first transaction is lettered as opposed to numbered, or we don't have a date, but we know that these occurred in October. So the first thing that happened is Schwartz deposited $25,000 of his personal funds into a bank account in the name of the business. So Schwartz, the person, is putting $25,000 into an account at a bank in the name of P. Schwartz, attorney at law. That's the name of the business. So what did the business get? The business would record a get for $25,000 of cash. What did the business give? The business gave to the owner a claim against the business of $25,000. So we have our get, 25,000 in cash, and we have our give, which is an investment into the business by the owner. This is an example of a financing transaction because we have the owner investing money into the business for that business to be able to operate. The second transaction is, it says, bought office equipment on account from Quipco for $9,670. Again, what did the business get? What did the business give? Well, and on the get side, we have that they are receiving office equipment with a value of $9,670. So that is the get, office equipment. What did the business give? Well, the business gave a promise to pay Quipco in the future. So that is my give, a promise to pay $9,670 in the future. This is an example of an investing activity because we are purchasing, the business is purchasing a fixed asset, office equipment. It's called a fixed asset because it's an asset that will be used over several years. The third transaction involved Schwartz investing his personal law library, which cost $2,800. And so we have another investment by the owner. However, this time it's not cash, it's a tangible resource in the form of the law library with a value of $2,800. So what did the business get? The business got a library or library books valued at $2,800. What did they give? Again, they increased or gave an increase in the claim that the owner has on the business for $2,800. Notice, as we have been doing so far, the get amount and the give amount are the same. And just like the first transaction where cash was invested by the owner, even though this is a non-cash investment, it still falls in the category of a financing activity. The next transaction is where the business paid the office rent for the month $1,700. What did the business get? The business got the use of the office building. So the business is the rentor and someone else, it could even be the owner, is the landlord. So from the perspective of the business received the use of the building and the cost is $1,700. And what did the business give? The business gave cash of $1,700. This is an example of an operating activity because this is part of the daily operation of the business. The next transaction is where the business bought office supplies for cash, $418. What did the business get? Office supplies worth $418. What did the business give? The business gave cash, $418. This is another example of an operating activity. Transaction F. The business bought insurance for 2 years, $944. What did the business get? Insurance coverage for 2 years for a total value of $944. What did the business give? The business gave cash, $944. Another operating activity. For transaction G, we have the business selling legal services. So this is the attorney providing legal services for cash, $8,518. However, the business is regarded as the one providing the service, even though the actual service was provided by the owner. So what did the business get? The business would record a get of cash, $8,518. And what did the business give? The business gave services to customers with a total value of $8,518. Again, notice that the amount of the get is equal to the amount of the give. This would be an operating activity. Then we have H. Transaction H, paid the salary of the part-time receptionist, $1,820. What did the business get? The services of the part-time employee, valued at $1,820. What did the business give? The business gave cash equal to that amount. An operating activity would be the classification for this particular transaction. Transaction I, received and paid the telephone bill, $388. What did the business get? The business got the telephone service for the month. Cost is $388. What did the business give? Cash equal to that amount. This is an example of an operating activity. Please note, however, that if this had said received the telephone bill for the month of $388, we would still record a get of $388, but the give would not have been cash. The give would be a promise to pay the amount in the near future. So it still would be recorded, but we would have a different give. It would be a promise as opposed to giving cash right away. Next, we have the receipt and payment of the utility bill. Similar to the one before, the get would be the utility service. Cost is $368. The give would be the cash. Again, if we receive the bill but we did not pay it immediately, we're going to pay it in the future, we would still have a give, but it would be a promise to pay in the future. Another example of an operating activity. Let's just jump right into the next one, which is the sale of legal services for cash, $9,260. Here we are going to record a get of the cash, $9,260, and the give would be the legal services. This, of course, would be an operating activity. What if they had provided the service and the customer is going to pay them in the near future? Well, the get would be different. The get would be a promise to be paid as opposed to cash, and the give would be the same. But of course, we did get the cash, and so we record the get of cash for the amount. Let's move down to the next transaction where we made a payment on account to Quipco. Recall that we bought the office equipment from Kipco for over $9,000. Now we are making a payment against that balance. Well, not we, but the business is. So what did the business get? The business got a reduction in the amount that they owe of 2006.20. And what did they give? The business gave cash of the same amount. So notice that this is not revenue or anything like that. The get is a reduction in the amount that they owe. So they owed over 9,000 and now they are making a reduction in that amount that they owe. Another operating activity. We're almost there. This is M, where Schwartz withdraws cash for personal use. So this is almost the opposite of what happened at the very beginning. In the very beginning, Schwartz deposited money into the account of the business, but now he's taking money from the business for personal use. And so in this case, the get is going to be a reduction in the amount that he can claim against the business of 2,500 because he's taking money back for his use, and the give would be the cash of the same amount. This would be an example of a financing activity. So we started with a financing activity, which was cash coming in from the owner, and we ended with a financing activity, which is cash going back to the owner. Now that we have analyzed all of the transactions, we need to put them in a form where we can readily see the impact that they had on our business. And so we are going to be grouping those transactions based on things they have in common. So for example, if they involve cash, we're going to put them into the cash group or the cash account. If they involve supplies, we're going to put them into a group called supplies. If they involve prepaid insurance, we're going to put them in that group. So each transaction is going to be placed in two or more different groups. You will not have a transaction that will involve just one group. It will involve at least two different groups. So just like we need to have two parties, when you are recording a transaction, you will have at least two different groups. So if you go back to our analysis, you recall that we had a get of $25,000 of cash, and we had a give to the owner of a claim of $25,000. And so you can go through each of these and you will see that the give and the get are recorded. Here we had a get of office equipment. Remember when they made that purchase? And we had a give, which was a promise to pay the amount. Then we had another get, which was the library books, or the law books, I should say, which went to the library group. So that was our get, and our give was to increase the claim of the owner of the business. Let's pause here and note something. Whenever you record a get or a give in the same account, it's going to increase that account. For example, this is a give, this is a give, so these two are going to increase the overall amount in that account. But let's look at what happens if you have a give and a get in the same account. So let's come down here. Recall that this was this was a give where we were paying $1,700 for the rent. This give is going to decrease this get. So a get and a give in the same account is going to affect the direction of the change. Whereas here, if you have a get and a get in the same account, it's going to increase. But if you have a get and a give, it's going to decrease. Same thing would happen here. If we come all the way down to the last transaction, when the owner took the money out, this amount here is going to decrease the overall total. So you can look at these and you will notice that every time I recorded a get, I recorded a give, or every time I recorded a give, I recorded a get. Now, the template that you are using will automatically do the addition and subtractions for you. So you simply need to be sure that you enter the amount in the correct column. So we have a column for cash, we add and subtract. We have a column for supplies, we add and subtract. In this case, we only added to our supplies. We only added to our prepaid insurance. We added to our office equipment. We added to library. We added to accounts payable, but then down here we subtracted because we made a payment, and so we got a reduction in the amount that we owe. So notice before the payment we owed 9,670. After the payment it dropped down to $7,000. Over here you can see that we have our revenue, which is the income earned from providing a service or selling a product, and then we have our expenses. So in this case, the revenue is referred to as professional fees. That's the specific name that we would give to the account, but it comes under the general category of revenue. Similarly, we have expenses, which are costs incurred in earning revenue, but the specific name for the expense would be rent. So we can tell how much we paid for rent, or it would be salary. So we know how much we had to pay for that particular expense. So we give specific names to each of these expenses depending on what it is we are paying for. On the assets, assets are items of value that we own. The business in this case owns. So they own the cash, they own the supplies, they own the prepaid insurance. Now, some of these assets are going to last longer than others. For example, the prepaid insurance is going to be gone in 2 years. The supplies could be gone in a week, a month, or by the end of the year, whereas the office equipment is expected to last for several years. Once we have recorded the give and the get for all of the transactions, we will get a total for each of these categories or groups. So this is the total for cash, this is the total for the office supplies, and so on. And we will need to now verify if our totals are in agreement, because remember, every time we recorded a get, we recorded a give. So all of our get should be equal to all of our give. And we will need to check to see if that's the case. So here is a convenient way for us to check on the accuracy. Now, the way the template is set up, it will automatically populate these rows for you. And so if you enter the amounts correctly in the different columns, you will automatically have the correct totals here. And if they're correct, you should see the totals in green, except for the expenses, which will show in red. I think the drawings will also show up on your template in red, but generally speaking, if the answer is correct, then it should turn to green. So I look at my totals, I can see all the assets, items of value that are owned. Total is 45 $1,802. So that's the total of all the get. And then we have accounts payable, which is how much we still need to pay. And we have the capital. And I want you to notice something interesting here, that revenue increases the value of the business to the owner, expenses decrease that value. And so over time, you want to be sure that you have more revenue than expenses, which means you need to have a profit. And if that's the case, then the owner's equity or capital will continue to increase, unless, of course, the owner takes out all of it or most of it in the form of what we call drawings, which is funds or in kind taken from the business for personal use. And so total liabilities, which is the net give to outsiders, plus the total to the owner, the sum of those two equal all of the assets. Another way of thinking about this is the assets or resources of the business are funded by outsiders as well as by the owner. So let me close with two final things. One is to give you an idea of the different names that these groups can have. So we talked about assets being items of value that are owned, but the specific groups within that category can have different names. For example, you could have an account called cash, or checking, or money market, or savings. But they all would have one thing in common, and that is they would be assets that are used to record the monies that the business has or the person whose assets we're looking at. Other assets or names could be accounts receivable. The key word here is receivable because we are looking at it from the point of view of the business, and we're saying accounts receivable is for amounts to be received in the future. It could also be notes receivable because they actually signed a promise to pay the business, or the business has a signed note that they will receive, as opposed to just an open account where the customer agrees that they will be paying or the business will be receiving. Other names for assets would be things like inventory, supplies, prepaid insurance. You've seen some of these already, and you will be coming across additional names as we go through the course. What are some popular names for liability accounts? Well, the key word here for liabilities would be payable. Again, we're looking at this from the point of view of the business in whose books we are operating. So you use accounts payable to record amounts to be paid in the future. So accounts payable would be for liabilities, whereas accounts receivable would be for assets. Again, notes payable, because from the point of view of the books that we're looking at, these are amounts that the business will have to pay. Unearned revenue will be an account that you will see in chapter 10, I think. Wages payable would be for wages to be paid by the business in the near future. Long-term debt. These are all examples of accounts that would be appropriate names for liabilities. What about revenue? Well, let's deal with equity first to finish that side of the equation. So names that could be used for equity accounts would be capital, and maybe you add the name of the owner to the word capital. So P. Schwartz, for example, capital account. Or it could just be capital or capital stock or common stock. These are all names that you may come across. Well, you wouldn't see common stock in your course because We're not dealing with a business that issues shares, but let's not get too complicated. The bottom line is these are names that could be used for equity, and you will not have to decide on the names. The owner of the business decides what the names are going to be, and they prepare what is called a chart of accounts. Withdrawals would be another name that you would see, but the one that is used in this course is drawings. This is another account that could be used depending on the type of business, dividends or retained earnings. But for this class, we're using drawings to record amounts taken out by the owner of the business for personal use. The penultimate category, revenues. Revenues, of course, represent income earned from either selling a product or providing a service. So the name of the group that we use could be service revenue, professional fees, attorney's fees, sales. The key thing is to notice that if it does not have the word expense at the end of the name, then it is revenue. So you may see professional fees and think, that could be an expense. But it's not, because if it were, it would say professional fees expense. So let's look then at the final category, which is expenses. Now, in this category, you can have group names or account names such as professional fees expense. Notice that the word expense is added on here. Rent expense, salary expense, cost of sales, cost of goods sold, depreciation expense, supplies expense, insurance expense. So notice supplies, which is asset that we had up here, is an asset, but supplies expense, which is to record the amount of supplies actually used, is your expense name. So hopefully this helps you to determine when you're looking at an asset versus revenue versus expense. The key thing for expenses is to look for the word expense being a part of the name. It's not always there. For example, it's not here, but usually the word expense is a part of the name of that particular account. And so I close with a summary, if you will, of what we have been discussing. As I shared with you at the very beginning, every transaction will have a get and a give, and the get and the give will have to be recorded from the perspective of the person or the entity in whose books we are recording the transactions. So if we are recording it for the bank, we look at it from the bank's perspective. But if it's from the business other than the bank, we need to look at the business perspective. So here are some general rules. Whenever you record a get, if it goes into an asset, it's going to increase the asset. If it goes into an expense, it's going to increase the expense. So generally speaking, assets and expenses are initiated when you have a get. So if you are recording a get, most likely you're going to be increasing an asset or increasing an expense. But that's not the only possible impact. What if you have a get that needs to be recorded in a liability? For example, recall when we paid a portion of the amount owed to Quipco for the office equipment. That was a get, but it's a reduction in the amount that was owed. And so when you do a get in a liability category, it's going to decrease. Same thing for equity and the same thing for revenue. So not all gets are created equal. It depends on the category in which the get is being recorded. If it's being recorded in an expense or asset, it will definitely increase either one or both. but if it's a get recorded in a liability, equity, or revenue, it's going to decrease. Similarly, when you record a give, it will increase your revenue. For example, when we gave our services to our customers, we recorded it as a give in the service revenue. That was an increase. Or if we record a get in an equity. So, for example, we recorded the $25,000 that the owner invested. That was a give, but it was in an equity account, so that was an increase. Same thing, we recorded an increase in the amount owed to Quipco. And so whenever you have a give and it goes to revenue, equity, or liability, it's going to increase either one of those. But if it's recorded as a give in an asset, for example, if you gave cash, it would decrease that asset. Or if you recorded a give in an expense, it would decrease. I I hope you found this this video to be helpful. If you have any questions, please contact me and I will be glad to be of assistance.